Of SIRC of ICA welcomes you all to the deep dive session episode 2, income tax case studies and insights. Please rise for motto song.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यतीतश्च एतद्वैता 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 एतद्वैता.
I would like to request CA Sudha Ashok and CA Anirudh to occupy the dais, today's speakers. I would like to introduce CA Sudha Ashok as an accomplished chartered accountant and cost accountant with over 30 years of extensive experience in finance, audit, taxation and regulatory matters, establishing herself as a leading expert in her field. She serves as a national leader in tax compliance in a leading firm, demonstrating proficiency in both direct and indirect taxes, ensuring adherence to the latest regulatory requirements. With a robust background in tax litigation, she expertly manages cases at various levels, including primary forums, dispute resolution panels, appellate forums coordination, and the authority of advance ruling, showcasing her ability to navigate complex legal landscapes. Her rich experience encompasses corporate finance, accounting, audit, and SOX compliance, providing clients with comprehensive financial insights and solutions. Recognized as a strategic partner, CA Sudha Ashok has proven track record of delivering significant value in the highly intricate and ever-evolving tax environment, enabling businesses to achieve compliance and operational efficiency. She also possesses substantial expertise in international taxation and transfer pricing compliance, equipping her to address global tax challenges effectively. And also I would like to introduce CA Anirudh. A qualified chartered accountant, comes with over 5 years of post-qualification experience in corporate and international taxation. He has expertise in handling international tax and transfer pricing assignments. He regularly advises on corporate restructuring, inbounds and outbound investments, and cross-border transactions. He has represented clients before authority for advanced rulings, appellate authorities, and also as a part of APA negotiations. He regularly speaks at tax forums on various international tax topics, including Pillar 2, UN Framework Convention, etc. So, with this introduction, I would like to welcome both the speakers to today's CPE program. I would like to request CA Ganesan to present the memento to the speakers. Over to speaker.
Today on the case law insights, what we are going to cover is first on the domestic taxation, which are landmark judgments, which would be not so ordinary judgments which has come in and which are recent enough. And then we will go into international taxation and the transfer pricing case laws. The first one, we talk about Supreme Court in the case of Bharati Cellular versus Assistant Commissioner of Income Tax, which was in 2024. The Bharti Cellular is a cellular mobile telephone service provider. It had entered into agreements with franchisees and distributors. Assisi sold these products as a discounted price. Assisi claims this discount was not commission or brokerage, and the revenue contention was 194H. So let's first talk about how the model works. See, in any telecom operator kind of model, what it happens is there's a telecom operator, and there is a sale of prepaid recharge vouchers which is given to the distributors and franchisees, and there are retailers and customers. So retailers and customers. Now what happens is, you know that on the price of the product. So as far as the price of the product is concerned, there is an MRP which is there, maximum retail price which is there on the products which has to be sold, and the sale to the ultimate retailer or the customer cannot exceed that MRP. So that's the model normally works. But when this distributor gets from the telecom operator, obviously it has to be at a discount for the simple reason that, say, for example, if you take the MRP price is 100, and the price at which the telecom operator has to give it to the distributor obviously has to be with a discount, because otherwise then he's not going to have a profit. So the entire profit is derived from the sale of the distributor and franchisee to the customer, and that is exactly the model which works. So assuming in this particular case there is an MRP of 100 which is on the product, and there is a discount of 20 and the price is at 80. So this is how normally a distributor, telecom operator and distributor model works. So what was the treatment? This discount of 20, as per the telecom operator, his contention is basically it's a principal to principal relation, and it's a transaction which is not liable for TDS. And as per the revenue, they were saying that it's a principal agent relationship, and TDS is required to on 194H as discount is commission income in the hands of distributor. So what they are talking about is this amount, what they are, the revenues contention is that this amount of 20 should be treated under commission, and then it has to be considered. See, what has to be highlighted here is that even though the MRP is at 100 and there is a price at which the telecom operator is giving to the distributor is at 80, the distributor is at liberty to sell it to a customer at any price what he wants, provided it doesn't exceed that 100. That's how the pricing works. So if he is going to say, for example, the distributor is going to sell to the customer at 90, so he is going to have a profit of 10 rupees over there. So this price of discount is not in the nature of commission, because it is not known what is the price at which the distributor and franchisee is going to sell to the customer, and hence their argument is we cannot charge anything, and this cannot be a commission which has to be taken, this discount cannot be considered as a commission. So normally in this basic model of franchisee distributor agreement, the key terms are the franchisees and distributors, they are appointed to market prepaid services and appoint retailers or outlets. Distributors cannot work with competing cellular service providers. So this also normally happens when a distributor is there, and if he is going to sell a particular product, a particular telecom operator's product, he is not supposed to do it for others. And distributors must pay in advance for the welcome kit. There's SIM card, recharge vouchers, and the telecom operator provided the products at a reduced price, and they are sold or transferred to retailers and consumers after the purchases are made. That is also again very important. Are free to sell at any price up to the maximum MRP. So this is what normally an agreement in the distributor agreement will have the relevant terms. So as far as the ownership, because what we need to also see is who is the owner of the product and what's the kind of documentation they have. As far as the ownership of the products is concerned, all prepaid products remain the property of the assessee, obviously. In this particular case, when we talked about this Bharati Telecom operator, the products are that of the assessee. At any point of time, it is not passing over. The products are not the property of the franchisee or distributors, and the ownership is not getting transferred. And customer documentation must collect signed agreements or contracts from customers. Completed forms must be submitted to the assessee for verification and records. And product availability, of course, he has to maintain sufficient quantity of prepaid startup packs and recharge coupons in order to meet the market demand, and sales targets are always reviewed by the assessee periodically. So additional requirements is they are responsible for storage, safety, insurance and losses. They have to maintain infrastructure and follow the policies, hire staff as per the assessee standards, comply with all legal and tax obligations. They have to modify the infrastructure on assessee's instructions at its own cost. So now what is the key legal questions in the particular thing? We talked about the background. We also talked about what are the relevant terms in the agreement, how the model works, and what's the kind of pricing they would be having it in this kind of situation. So the key legal questions which arise in this particular transaction was, does the discount given to distributors or franchisees amount to commission? So that's the entire contention of the revenue. Is there a principal-agent relationship or is it a principal-principal relationship? Can TDS be enforced under 194H in such transactions? So these were the key questions which was required to be answered in that particular case. So high courts had given conflicting decisions. Delhi and Calcutta high courts had TDS applicable under 194H, and Rajasthan, Karnataka said that it's not applicable. So let's go, then before we go to the what was given as part of the verdict, let's understand what this 194H says. 194H says any person responsible for paying at the time of credit or at the time of payment, whichever is earlier, to a resident, any income by way of commission or brokerage shall deduct income tax in the prescribed rate. This is normally there in any TDS provisions as such. The explanation says expressions, commission or brokerage to include any payment received or receivable directly or indirectly by a person acting on behalf of another person for services rendered not being professional services or for any services in the course of buying or selling of goods or in relation to any transaction relating to any asset, valuable article or thing not being securities. Because it has the word acting on behalf of another person for services rendered. This is where the revenue had its own contention. So revenue's argument is, the prepaid SIM cards remain the property of Bharati Cellular. Franchising distributors never own the cards, because that's what we saw completely in the model, wherein we said it is going to be the property of the cellular operator. It is never, the ownership is not getting passed on. So they are the owners of this, and it was not a sale but a service model. Franchisees and distributors were acting on behalf of the telephone company, fulfilling statutory obligations, because we also talked about they are only acting on behalf of that. Hence, they were agents and not independent buyers and sellers. Revenue stressed any payment received or receivable. This is there in all the TDS sections. Of course, it talks about whether it's going to be received or receivable or directly or indirectly acting on behalf. Since franchisees earned income from reselling the telecom products on behalf of Bharati Cellular, that income difference between discounted price and sale price amounted to commission, triggering an obligation. So this was revenue's argument. So what was the decision in favor of from the Supreme Court? What it said is, although the SIM cards remain the property of Bharati Cellular, that's only due to licensing obligations imposed by Department of Telecommunications. See, because what also happens is, we need to go not only by the terms of the agreement or the terms how the model works, we also need to see whether there are any regulatory authorities who are restricting them to do something. That is what is very important, because say for example, if you take a Motor Vehicle Act, it has certain restrictions in say to who is going to be the owner of the car. So if you're talking about a lease transaction, then you need to be also aware that what the Motor Vehicles Act talks about. Similarly, Department of Telecommunications has its own licensing obligation, so that has to be fulfilled. So that's the one which is ensuring that this model works between the franchisee and the franchisee distributors and the telecom operator, and of course the customers. In actual practice, the right to use a SIM card in this possession is handed over and given to the end user, that is the customer who installs the SIM card in his phone. Because the SIM cards are not opened by the distributors or franchisees before selling it, it's coming in the sealed packet and it's given to the customer opens it and he only installs it, the SIM card. So if you see, honestly, it's only taking from the telecom operator to go to the customer ultimately. He is only there enabling this particular transaction as a service and he is not selling the products. Agency is a triangular relationship between the principal agent, principal customer, but such a relation does not exist. This is what is very important. Because the revenue's argument was that it's a principal agent relationship because they are selling it on behalf of the principal and hence it has to be a principal agent relationship. But what the thin line of difference there is, now if there is a thin principal agent relationship, there is also a triangular relationship which exists between the principal agent and the customer. But in this particular case, it doesn't exist. Such a relation does not exist because the principal agent and customer do not have a triangular relationship in this transaction. Distributors purchase at a discount and the profits depend on their resale price, obviously, because what we talked about is 100 rupees is the MRP. When the telecom operator is giving it at 80, the distributor can sell it as 90 to the ultimate customer. So there is a profit element of 10 which is going to the distributor per se. So the difference between the final sale price and discounted price is the margin or the trading profit of the distributor. TDS under section 194H is applicable only when there is a payment of income by way of a commission or brokerage directly or indirectly. So revenue has stated that there is an indirect payment to franchisee which is in the nature of commission, but the payment being received are not being received on behalf of Bharati Airtel but on their own account. So the payment whatever they are receiving from the sale to the customer is what the distributor gets, it's his profit. It is not received on behalf of the principal. Then there is no direct or indirect payment or credit for the distributor of the services rendered in this particular case. The law requires TDS on the actual payment or credit of income whichever is earlier, earns income only when they sell the product or retailers based on the difference. The income is not paid or credited by the cellular provider. So this is very crucial. See, what we are saying is TDS we are talking about, it has to be deducted at the time of payment. But then in this particular case, the products are given to the distributors or franchisees at a cost, at a value, whatever is determined by the telecom operator, which is not exceeding, of course, will not exceed the MRP. When the franchisee or distributor is selling to the outside customer, that is the time when he is earning a margin on that particular thing. So it is not something as a commission which they are paying here. Revenue has also stated that TDS should be deducted on the difference between the principal price and the discounted price. But revenue cannot insist that franchisee distributor must sell the products at the printed price. That's also obvious. If the MRP is going to be at 100, at any point of time the distributor is not going to sell 100. He cannot, say for example, he cannot afford to sell it at 110 or 120. He has to sell it either at 100 or lesser than this. To get more customers, obviously he will be selling at a discount, so he has to sell only at a lesser price. So they cannot say that the price at which the 100 is marked, which is there in the MRP, and the 80 rupees what he has given will be the discount, because he can also sell it at 90, he can also make it at 85. So if that be the case, they cannot assume that it's going to be sold at a profit of 20 and that becomes a discount, and that has to be partaking the character of a commission or a brokerage. The contractual obligations of the distributors and franchisees do not reflect a fiduciary character of the relationship or the business being done. We are unable to visualize indirect credit in the books, and revenue is not entitled to expand the scope. Therefore, no TDS under section 194H is applicable, as there is no commission or brokerage involved from the provider's side. So that's on the first case. Let's go to the second case on Jupiter Capital. So in this case, the first appeal, CAT appeals was in favor of revenue. The second appeal in ITAT, it was in favor of the assessee. The third appeal is High Court of Karnataka in favor of the assessee. And then the fourth appeal in Supreme Court, of course, it's in favor of the assessee. So the background is here, Jupiter Capital made investment to an Indian company engaged in the business of telecasting news. And the shareholding was 99.88%, and it was holding something like 15.33 crores of shares. The company incurred losses and hence capital was reduced. So whenever a loss is there, huge losses are then company, one of the things what they do is also on the capital reduction. So the shares became 9,998. The face value was at 10. The court directed a payment of 3.18 crores. During the year, the assessee claimed long-term capital loss accrued on reduction of the share capital, and he was asking for reduction, treating such reduction as a transfer. And whether this is amounting to transfer of a capital asset under 247 is the question where capital loss can be claimed. So this is how the, before the reduction of share capital, this is how the share capital looked like. The Jupiter capital was 99.98, which is 15 crore shares with Asianet News Networks, and others were at 0.12, 1,64,000 shares, and the total number of shares at the face value of 10. So after reduction of share capital, the same percentage was retained. So if you see here, the same is 99.88 and 0.12. The percentage was the same after the reduction of the share capital, which is again at 99.88, but the number of shares got reduced. From 15 crores, the number of shares became 9,988, and for others, it's again the 12 shares, and the total number of shares was 10,000 now with a face value of 10. So the revenue's argument is when the number of shares reduced, however, the shareholding percentage was the same. So they were talking about the shareholding percentage irrespective of whether it's a 15 crores or it's a 10,000 shares. The percentage what was held by the holding company in this particular case remained the same. There was no change in that. So the shareholding percentage was the same. It's only a reduction of the number of shares. The AO argued that there was no extinguishment of shareholders' rights, only a reduction in quantity, not in ownership rights or value. Because you know that when a share capital is invested, there is also a voting right, and also shareholders have a specific right in terms of their profits, what the company is earning. So they are saying the shareholders' rights have not diminished in this. The same 99% of rights, whatever they were retaining when the shares was 15 crores, was also continued to be held by the owner in the case of 10,000 number of shares also, and hence there is no extinguishment with legal documents or court orders. It is not equating to any rights which has been actually given out by the company. The assessee did not sell or transfer the shares to anyone. Even after the reduction, it remained the same. So there is no real loss. It's only a notional loss. That's the argument revenue had. Hence, this does not constitute a transfer, and therefore capital loss is not allowable. That was the contention of the revenue. So the legal question here is whether a reduction in share capital along with proportionate reduction in share capital of shareholder amounts to transfer as per section 247. So for that, the relevant provision is basically the section 2 subsection 47, which talks about transfer. It says transfer in relation to a capital asset includes. It is an inclusive definition. It is not an exhaustive definition. But again, in includes itself, it very clearly says sale, exchange or relinquishment of the asset or extinguishment of any rights thereon. So it's too wider a term. So if I'm saying that it's not only taking about sale, it's also talking about exchange. It is also if you're extinguishing any rights, you have a right on a particular number of shares, you are giving those rights across, and that also will contribute as transfer for the purpose of section 247. So the Supreme Court gave it in the favor of the assessee. It said 15.33 crore shares which were reduced to 9,988 shares after the capital reduction, and it was also asked to have an amount of 3.18 crores in cash. The AO's view that the voting power has not changed, has remained unchanged, is not tenable, and they have said it was held that the share capital of the subsidiary and subsequent proportionate reduction would be squarely covered under this definition what we talked about, sale, exchange or relinquishment of the asset under 247. So transfer is very wide here, which is defined because it is going to cover all the situations what can be considered as a transfer, and it includes, as we already discussed, not only the sale but also the extinguishment or relinquishment of any rights in the shares also is considered under transfer. Even if a person continues to be shareholder after capital reduction, it cannot be said that no part of the rights have been extinguished, and it also recognizes that capital gains can arise not just from an outright sale, it can also come out of this. So the next, let's go to the case on High Court of Bombay and Technova Imaging Systems. At CIT level, first appeal, favor of the assessee. ITAT was in favor of the revenue, and the third appeal is the High Court of Bombay was in favor of assessee. So here the facts of the case is Technova Imaging System was engaged in the manufacture and sale of aluminum based lithographic plates, chemicals and polyester used in printing and image transfer industries. So these were the amalgamation details. So they went for an amalgamation. Technova Graphic Systems Private Limited is amalgamating company 1. Image Printmakers Private Limited was amalgamating company 2, and Technova Imaging Systems were the amalgamated company. See, what happens is amalgamation per se, which is covered under 72A, there was a difference in the 72A in those days, and now what is the revised 72A, what is applicable as of today. And in this particular case, obviously when we talk about an amalgamation, we normally take whether 72A is applicable in the case of an industrial undertaking, ship or a hotel, where we talk about whether it's applicable. Then if it's applicable, obviously the depreciation and the unabsorbed depreciation and the loss can be carried forward. So in this particular case, the Technova Graphic Systems amalgamating company and image print makers, they merged into this amalgamated company, which is this Technova Imaging Solutions. So both the amalgamating companies had unabsorbed depreciation at the time of amalgamation. Both of them had. The amalgamated company did not claim the carry forward of this unabsorbed depreciation under section 72A because it was not possible to do it under 72A at that time. So we'll come to that. What was the amendment later and what was the amendment early, what was the original provision earlier. According to the assessee, the benefit under 72A was not available as none of the amalgamating companies were financially viable. it recomputed the WDV of the transferred assets and adding back to the unabsorbed depreciation. So let's go to the provisions first. Okay. See the relevant provisions of the Act. 72A, what is relevant in 1992-93 was, if the company that owns an industrial business amalgamates with another company in the central government is satisfied, was not financially viable. This was the clear distinction which happened earlier, because that is not available in the new provisions now, and it's in the public interest, and any other conditions are also met to ensure that the merger helps revive or rehabilitate the business. So basically, the objective of the revenue giving an importance to the 72A in the case of amalgamation those days has been that if there are loss-making companies, obviously in the public interest, and say for example, there is a huge losses and it's the public interest, they want to ensure that those loss are revived, the company is revived and the loss are set off, then they can advise for or give a approval for amalgamating them. So the word of financially viable and in the public interest was very, very important those days. Then the accumulated loss and unabsorbed depreciation of the merging company would be deemed to be the losses and unabsorbed depreciation of the amalgamated company. So since in this particular case, they didn't fulfill the condition what is specified there in the public interest and financially viable part has not been fulfilled, they said it's not applicable, 72A cannot be claimed. They cannot claim the relief under 72A, and hence they recomputed the WDV, and under explanation to section 43(6) of the Income Tax Act restricted the depreciation. The AO, however, they restricted the depreciation and said that it cannot be done. So the revenue's contention was such benefit can be claimed only under 72A in the form of carry forward of unabsorbed depreciation, which requires a specific order. The AO rejected adding unabsorbed depreciation of amalgamating companies, and hence they have restricted this depreciation carry forward. Assessee's contention, they are saying no carry forward or unabsorbed depreciation was claimed under 72A because of these conditions were not met. However, there is no restriction to claim it under WDV, because this is very important to note, this is of relevance even as of today. When we are talking about actually allowed means if there is something lying in unabsorbed depreciation, that means it's not been allowed. They didn't have enough profits to ensure that it is absorbed. See how it works, you have a depreciation, you have a business loss. So the first, when you are doing it, when you have adequate profits, then it is getting absorbed by the profits. If the company do not have adequate profits in the year in which it has depreciation, then the depreciation is not getting set off against the profit, so it becomes carry forward. So the carry forward of unabsorbed depreciation means it was not actually allowed in that year, because it was only an amount which was there in the books of accounts, but it was not claimed in the ITR, it is carrying forward for the previous year. So this was the actual thing what the where it lies it, and it is also in the current thing, because it's actually allowed even now it is there. So that's something actually allowed is taken as part of the WDV of assets of the amalgamating company. So during amalgamation, what we do is when we take the assets and liabilities of the amalgamating company to the amalgamated company, you take the assets and liabilities of the assets, especially on the WDV of the assets. So in that WDV, this unabsorbed depreciation, which was not actually allowed in those years, was taken as additional claim in the as part of the section. So that's what the that was the contention where revenue said that is not possible. So let's go to the provisions, relevant provisions of 32. So 32 talks about for depreciation, unabsorbed depreciation can be carried forward to subsequent years until it is fully utilized. That's what it says. 43(6) explanation 2 says if any block of assets is transferred during an amalgamation, then the actual cost of the block of assets for the amalgamated company will be the WDV of the amalgamated company for the immediately preceding year, reduced by the amount of depreciation that was actually allowed. So that's what this section says. So if 72A is not allowing the company to claim under unabsorbed depreciation to be carried forward because that 72A condition was not fulfilled, the assessee has gone to this section wherein because 32 says that its unabsorbed depreciation can be carried forward to subsequent years, and it also says under 43(6) that it uses the word actually allowed. So actually allowed means it is not actually allowed for the simple reason that there was no profits to absorb the depreciation, and hence it was only carried forward to be set off at a future date, and hence this should be allowed. So the legal questions in this particular part, what came in is whether 72A of the Income Tax Act is applicable to this amalgamation. That was one of the questions. Whether the unabsorbed depreciation of the amalgamating companies can be added for the purpose of computing WDV in terms of explanation 2 to 43.6. Whether the appellant's depreciation claim on the enhanced WDV is valid under the provisions of section 92 and 43.6. So, what the court said in this, the court held that the assessing officer discussion. So, what the court basically said is, even the assessee is not asking about 72A. See, if the assessee is saying that I am claiming under 72A, then the department has every chance to say that 72A is not applicable because of those conditions of public interest and financially viable whether it has to be met. All those are not fulfilled, so you are not claiming it. But the assessee's contention was not at all in 72A. He didn't claim this under 72A. He went claiming in the other route of 43.6 and 32. And hence the adoption of the correct WDV, the block of assets pertaining to two amalgamating companies that merge into amalgamated company pursuant to a scheme of amalgamation. That's what his claim is. He never claimed on the first part on the 72A. He claimed only on this part. Accordingly, the applicability of section 72A was irrelevant because the department was again and again arguing on this point on saying that 72A is not at all applicable in this case. So, but that is not the question at all here. The assessee also knows that 72A is not applicable because he has not fulfilled those conditions. So, he has gone to the other route of taking under 43.6 because it specifically says whether it was actually allowed. It was not actually allowed in those years. So, and hence he is claiming it as part of this amalgamating WDV. The real issue that required adjudication was the correctness of the WDV adjustment claimed by the assessee. The relevant provisions governing such adjustment were contained in sections 32, read with section 43.6, including explanations 2 and 3 of the Income Tax Act. So, non-applicability of section 32, this also something was again discussed in the order. They have merged with the amalgamated, ceased to exist and hence they cannot carry forward. This section breaks down. Non-applicability or explanation to 43.6 is talking about actually allowed. So, cannot be deemed to be actually allowed because it is unabsorbed. Applicability as this explanation, they can actually take it in the WDV and it can be allowed for future. Okay, let us go to the fourth case on Flipkart. Now, we have, I think we have covered 3 sections on 3 case laws on domestic. Now, we will go to international taxation, then after that it will be transfer pricing. So, here application 195-2 for nil TDS in favor of revenue and High Court of Karnataka in favor of the assessee. So, background of the case is Walmart USA and Flipkart Internet India and there is this Flipkart Singapore. So, there is a master service agreement. I think most of the MNCs work under this model where they always have a master service agreement for, especially for secondment of employees. So, we know what a secondment of employees is. So, say for example, if there is a subsidiary which is set up in India and USA has that employees who have knowledge or technical knowledge or they might also be administrative or managerial staff who is able to run the business. At the time of startup, there are holding companies which will second those employees to the subsidiaries and they will be working under the supervision of the Indian subsidiary. However, as part of the, they claim because there is something called a host salary and the home salary which needs to be paid by both the entities and there could be a proportion on what will be paid in USA and what will be paid in India. This will normally work out in the case of secondment of employees because those countries, they will continue to be the employee for, say for example, in this particular case Walmart USA. So, if those seconded employees are given to India, they will continue to be the employees of Walmart USA. Once the secondment is over with India, say for example, it is going to be for 2 years or 3 years, they go back, they will continue to be the services. So, their social security obligations have to be taken care of in those countries and that is exactly why they do not just say that you need to resign in that company and then join in this company. This part of the process never works in any MNC because one is continuity of service. The next one is again social security obligations are there in those countries, in the home countries where they are. So, that has to be fulfilled. For fulfilling those social security obligations, you need to also have some salary paid. So, that is exactly why in any kind of this secondment of employees, it always have to be, there will be an employee who will be with the holding company or the ultimate holding company and this secondment happens and after the secondment term is over, they just go back to the holding company. So, in this particular case, what is the background is, Walmart USA provided secondment of employees pursuant to this master service agreement and MSA states that USA will invoice only compensation and wage costs of its attendees. There is not going to be any margin over there. Accordingly, the USA has seconded 4 employees to Flipkart Internet India by means of this global work assignment, and appointment letters were issued with job roles and PF contributions and employment visa details. Secondees worked exclusively for Flipkart India during the period. So this is what is very important. See, because what happens is normally when this secondment happens, and this is also a thin thing where you get into other issues, maybe with, may say, GST, or whether there is a PE which is getting established for those employees here. Those are kind of other things. But in this, the limited question is about the seconded employees' remuneration, what is being reimbursed. So the secondees worked exclusively for Flipkart India during the period, and initially for the seconded service, they remitted the salary amount to Walmart USA by way of reimbursement after deducting applicable TDS. So in this case, what they did was, since this process was going on, see, normally what happens is, this is the trend what all MNCs follow. If there is no clarity, or if they have a doubt, because you know that after filing your returns, after getting into thing, after a period of say 2 to 3 years, there might be a notice from the income tax department. So normally they go and apply for a withholding tax nil TDS certificate or withholding tax. That will give clarity as to what the transactions has been accepted. Of course, in most of the cases, those nil withhold TDS certificates will not be in favor of the, especially when there are controversial or interpretation related issues that will not be issued by the department. And of course, nowadays they are not even issuing the nil, it is going to be some, with some percentage it will be issued. So claiming the payments made to Walmart Inc. were not for any service, but merely a reimbursement of salary and employment related costs which were not liable to TDS deduction. So in this particular case, they have not even charged any markup. It was only a pure reimbursement for whatever salary was paid, the cost what was incurred, that is the one which was reimbursed. The AO rejected the application, holding that the payments were taxable as fee for technical service and thus subject to TDS. So Flipkart Internet challenged this rejection through a writ petition filed in the High Court of Karnataka. So the legal question here is, reimbursement of salary cost by Flipkart Internet, which is in India, to USA, is it reimbursement of salary which is non-taxable, or will it constitute a payment for fee for technical services or included services under 917 of the Income Tax Act and Article 12 of India-US DTA? Okay, so before we go to, we have to see what these provisions are. Section 9 talks about the following income shall be deemed to accrue or arise in India, income by way of fee for technical services. It's there. And it says in explanation, fee for technical service means any consideration, including any lump sum consideration for the rendering of managerial, technical or consultancy services, including the provision of services of technical or other personnel, but does not include consideration for any construction assembly, which would be the income of the recipient chargeable under the head salaries. So here, this fee for technical services definition is very clear. It says it's for managerial, technical or consultancy services. So in this particular case, if we are talking about USA providing services to India and then charging a service invoice, it could be classified as a fee for technical service. But in this case, it's only a reimbursement of salary. Salary part, what is can? So the recipient is chargeable under the head salary. So now let's go to the DTA provisions. Article 12 of India USA DTA says, fee for included services, because they use the word fee for included services, not as technical services, means payments of any kind to any person in consideration for the rendering of any technical or consultancy services, including through the provision of services of technical or other personnel if such services make available technical knowledge, experience, skill, know-how or process, or consist of the development and transfer of a technical plan or technical design. If you see there is a difference in the definition itself. In the DTA provisions, it talks about technical or consultancy services, whereas in section 9 it talks about managerial, technical or consultancy services. This is a little bit wider than what is there in the again the DTA provision. So as you all know, whenever we take a payment which is between a resident and a non-resident, the first is we need to check the Income Tax Act. What the Income Tax Act says, whether it's chargeable as per the Income Tax Act and liable to TDS deduction. That's the first step we do. So the moment we say conclude saying that it's chargeable, then only then you go to DTA provisions and take the benefit of DTA provisions, provided they fulfill the other conditions. So the revenues argument in this particular case, the employer-employee relationship continued between seconded employees and Walmart USA, not the Flipkart Internet. That's what we discussed. See, the employees will always be the employees of the holding company or the company associate enterprise which sends the employees, second the employees to India, because that has to be there for the social security obligation which has to be there, and also the continuity of service. And that is not to do something with the Income Tax Act, it's for meeting the obligations of the social security obligations and the other employer-employee relationship which has to be maintained is what those things are normally maintained. Therefore, the payment made by the Indian company is not reimbursement of salary. That's what the revenue's contention is. Instead, it is treated as consideration for technical services rendered by USA under 917. So, what they are trying to say is, the reimbursement whatever India is paying to USA, it's not the reimbursement because these employees are not, they are the employees of USA. It is indirectly they are saying USA is providing the services to India, and that services will be classified as fee for included services by DTA, and it's going to be fee for technical services as per India Income Tax Act, and hence it's under 917, it has to be taxable. That's what is revenue stand. So, the decision of the High Court in favor of the SSE, it talks about the MSA. Of course, the MSA was very clear. It was stating that it clearly provides for the secondment of employees. Walmart USA to invoice only compensation and wage cost of secondees. That clause is also there in the MSA. Accordingly, payments to Walmart USA were pure salary reimbursements, not income for Walmart. So, hypothetically, if we take that the salary of this 4 employees works out to say 1 crore, and then if there had been a percentage of markup which has been added, then there could be something which is to be talked about as a service. Even that can be argued otherwise, but I am just saying, extending that argument. But in this particular case, it's a pure reimbursement which has happened between the amount what has been paid to the employees has got completely reimbursed by the Indian entity, and hence it is only a salary reimbursement. Substance or form to be considered, global work assignment executed in terms of which either of the parties could use the services of seconded employees, and employees work under direct control of Flipkart Internet India, and appointment letters also were issued for job responsibilities, provident from contributions and employment visa procurement. All indicators show in existence of an employment relationship with Flipkart Internet India. See, that is the, what needs to be done is, most of the cases whenever we argue from the income tax perspective, we also need to be aware what are the other provisions which could impact those cases from the other statutory laws. That's very, very important, because those are the things which will determine whether those relationship, because the revenue's argument was, if you are an employer and employee in India, why would you reimburse to the US entity? Why should the US pay? But then that is very clearly clarified here. It clearly shows the existence of an employer-employee relationship with Flipkart India, because we saw in the previous slides that there was they have given what is the job, nature of the job, what they need to do. They have also given other things, what are the things they are going to supervise. So, those kind of things are very clearly documented. So, in that case, there is a substance which is there as an employer-employee for the Flipkart India here, and salary payments not considered fees for technical services and hence not liable for TDS deduction. That's what, so even if you assume, stretch of imagination, assume that it is taxable under Indian income tax, then you go to the DTA provision. In DTA provision, technical for included fees, it says India USA DTA, and also some of the DTAs like Singapore, they also talk about make available clause. So, what does it mean? Make available clause is a clause which is very wide in terms of, if a service is provided by an AE to an Indian entity, that service, this Indian entity should be able to perform it independently at a future point of time. So, even assuming USA is giving this service to India, will this service be possible for India to do on its own? Is that knowledge made available to them? So, that is the question here. So, DTA, even if they assume that the revenue assumes that it is covered under the income tax and it is taxable, under DTA it is very clear, it is not giving any, there is a make available clause for India USA treaty, and hence there is no technical knowledge which is provided. No experience, skill or know-how or process is required by DTA, hence the services cannot be considered as fee for technical service, non-fulfillment of make available clause as well. So, that is what the argument of the SSE. So, it is not, the first argument was it is not even taxable under income tax. Even otherwise, if you assume that it is taxable under Income Tax Act, it cannot be taxed under DTA, because India USA DTA very clearly mentions that there is a make available clause and there is nothing which is made available to the Indian entity. This make available is very crucial for most of the DTAs, and especially when we are talking about payments from India to group companies, we need to ensure whether those DTAs have make available. And of course, what is made available, again we need to also be clear about what are the kind of service they are providing. We have to break down the services and see whether something can be made available, whether in terms of a technical knowledge or in terms of skill or processes, and that is available to the Indian entity to execute on its own at a later point of time. Okay, with this, I cover the first part of the session. Now I'll ask Anirudh to start with the next case laws. Sorry? Okay, that part is not covered, but that is a different subject anyway. See, they are not bothered, they are actually subject to TDS. The employee salary has been subject to TDS, that's what they have given. But still that was not considered there, because what they are talking about is the reimbursement itself per se from India to USA. That's what the subject matter. So they were not talking about whether I have deducted TDS for the employees or not deducted TDS to the employees.
So, good evening, everybody. So, it's good that we also spoke about Flipkart in detail. It happened to be a case preceding to this. So, we saw that there were some secondment from Walmart to to Flipkart, etc. We'll probably now look at a story as to how Walmart itself became a shareholder of Flipkart and what were the issues surrounding it. We all know that Flipkart was a startup based out of India, etc. So it's basically a prelude to what has happened and also what is now pending with Supreme Court. Just before going into this, please feel free to intervene as much as possible. We can make this very, very interactive as well. And also particularly on the facts, right? So because the facts are super important in this case. Therefore, at some point in time, if you feel that you're not very clear with the facts or the provisions of the law, we can probably clarify as well as I'm waiting to hear some interesting thoughts from your side as well. So let's go to the facts of the case very clear, right? So Flipkart, initially the investments into Flipkart, the FDI investments into Flipkart came through US. So this Tiger Global is a private equity fund. It's an investment management entity, whatever they can call it as. As the facts transpire in 2009, as you can see there, Tiger Global Management LLC had acquired the Flipkart Online Services Private Limited India, right? So that was in 2009. Flipkart itself was incorporated only in 2008. So it has come as an FDI. Then what happened is, we will take this as a story. Tiger Global saw that there is some potential with Flipkart, etc. So they thought that at some point in time, as with all private equity investors, they would want to exit and make money, right? So at the time of exit, of course, there will be capital gain. So if it is going to be from US to India, and at some point in time, they want to either take it to listing or they want to sell it to some other group, etc. There will be tax liability, there will be capital gains in source country. So what they do is they kind of do a slum sale from Flipkart Online Services to Flipkart India. And through the slum sale structure, what happens is, this is the structure that is established, right? So you have Flipkart India, and then above that you have Flipkart Singapore, above that you have Flipkart Mauritius, above that you have above Flipkart Singapore you have Tiger Global Mauritius, above Tiger Global Mauritius you have a set of Cayman Island entities. So the structure is like this, right? So it's a investment vehicle, collective investment vehicle. Collective investment vehicles generally pool funds from a lot of investors across the globe. So in this case, it was around 500 investors from 30 plus countries, etc. The money was pooled in in Cayman Islands entity, and the money came from Cayman Islands to Mauritius, and from Mauritius to Singapore, and then from Singapore to India, right? So all these entities, as they call themselves, Flipkart Singapore, Tiger Global Mauritius, there is one more layer of Tiger Global Mauritius there, and then you have the Cayman Island entities. All these 4 entities are basically investment entities, right? So their business itself is to hold investments, collect investments from all the investors and then invest in Indian market, right? That is their business itself. So there is nothing to doubt about that. So that is very clearly coming out as well, right? So now what happens is this is the existing structure that you have, right? Now this transaction. So what happens is Tiger Global wants to exit Flipkart, right? So in 2018 they want to exit Flipkart. There is a deal from Walmart, right? So Walmart says that we will buy the entity. So there is a agreement between Walmart and Tiger Global saying that okay, we'll acquire the shares from you, right? Basically investments in Indian entity. I want to take over the Flipkart entity, right? Up to 74% stake, right? So for that purpose, Walmart designate Luxembourg entity from their side. And very interestingly, as has been the case with lot of cases starting from Vodafone, the sale does not happen at India level, right? So Mauritius entity does not sell Singapore entity does not sell the shares of Indian entity. Flipkart India shareholders remain the same, right? What do they do is, Mauritius entity sells the shares of Singapore entity. So if you go back a little, so Walmart is all concerned about this entity, right? This entity is the one that has all the value, etc., right? So ideally what would happen is that Walmart would buy the shares of this entity, right? From this entity, basically their shareholders, right? So if that happens, what happens is Flipkart Singapore would have to sell Indian shares, therefore there is taxability in India. Just to give a pretext, in Singapore there was no capital gains. Now very recently there is a capital gains taxation. Mauritius there is no capital gains taxation. In Cayman Islands there is no capital gains taxation, right? So all these layers, they do not have capital gains taxation except for India. So you don't want to touch India, right? So basically they say, okay, instead of selling the Indian company shares, what I will do is I will ask Mauritius, Tiger Global Mauritius, to sell the shares of Singapore entity. Singapore entity basically derives its entire value only from Indian entity, right? So therefore, in this manner, what we, in income tax, what we call as indirect transfers, right? So that is a very, there's a very old tested methodology, right? Right from Vodafone cases, you have this indirect transfers. So indirect transfer method was achieved in this case, and therefore there is prima facie, there is no capital gains at all. Okay, there is no capital gains taxation. Right. The only point of difference that we will have today compared to Vodafone case, or compare this with the Vodafone era, was that there were no indirect transfer provisions when Vodafone case came. Right. So that was the primary point of argument. Thereafter, the revenue came and amended the law retrospectively to introduce indirect transfer provisions under the law. Now, when this transaction happened, there are indirect transfer provisions, right? And it is very evident that Flipkart Singapore derives its value substantially from the Indian entity. Therefore, it is very clear that though Tiger Global Mauritius is selling the shares of Singapore entity, it is basically deriving its entire value from India. Therefore, it is a method of indirect transfer. Therefore, it is taxable in India. As per domestic law, it is very, very clear that it is taxable in India, right? So now what happens is, Tiger Global Mauritius sells the shares and it receives the fund from Walmart, right? Now, Mauritius in TG Mauritius hands, whether it is taxable or not is the question, right? So what they do is they go and approach the authorities and say that, see, I'm going to receive this money, right? You tell me whether it is taxable or not under section 197, right? So they apply for a TDS certificate, lower withholding tax certificate. Then the revenue says, no, it is taxable. Now there is more a layer to it, right? On the fact pattern. If you look at this, so if you look at the structure, you have Tiger Global Mauritius, which is a seller entity, right? So Mauritius has 3 directors, right? So there are 2 resident directors, and then there is one guy who is a non-resident director. His name is Stephen Boyd. It's there in the ruling itself, right? Now, above Cayman Islands, it's not above. Basically, for this entire thing, there is something called as Tiger Global LLC that you see there. Tiger Global Management LLC USA is designated as an investment management entity to this entire structure. Basically, whatever investment related decisions needs to be taken, it will be taken by, or it will be assisted by Tiger Global Management. They are called the investment management entity. They are not the shareholders anywhere, right? That entity is held by someone named Charles Coleman, right? So he is the shareholder, he is the owner, he is the controller of the entity, basically. So the revenues contention here is this, he takes all the shots, right? As to, you sell this entity, this entire structure is put in place, etc. Charles Coleman is the person who takes the entire shots, right? Therefore, Tiger Global Mauritius entity is not the actual seller, right? It was an interposed entity. The control with respect to the entire shareholding with respect to Indian entity is with the Tiger Global Management LLC, US entity, or to specifically put, they say that it's with Charles Coleman, who is the US resident. So once you say that, what happens is that we were talking about indirect transfer provisions, right? Under domestic law, it is taxable. It is very clear, right? So the entire structure is now around whether you are eligible for treaty benefit, right? All of us know that India-Mauritius treaty provides for a grandfathering of capital gains, right? The law says that if a Mauritius entity invests in an Indian entity prior to 2017, whatever capital gains arises upon sale of the shares, it will be exempt in India, right? That's what it says. So you are trying to use that route now to escape from taxation here, right? Now department comes back and says, the Mauritius entity is not at all an entity, it's a shell entity. It's a conduit entity, right? The directors that are there in Mauritius entity, they are all puppet directors, right? The one person who is there, Stephen Boyd, among the three directors, he is a general counsel to Tiger Global Management USA, and is closely linked to Charles Coleman, right? So therefore, he is the one who is taking the shots, or at least it's going to be Coleman who is taking all the shots. Therefore, if you remove Tiger Global Mauritius and Cayman Islands from this picture entirely, the head and brain test, so they call it as head and brain, basically for a company, since it's not a living thing, we try to identify what is the head and brain behind that entity. So they say that Charles Coleman is the head and brain behind this entity. We are talking about then a Mauritius entity which is not there, which is a conduit, which is which is sham, right? And then above that you have one Mauritius layer, and then one more Cayman layer. All these are flow through and pass through entities. Ultimately, it is controlled by the US shareholder or US person, right? Therefore, you are not eligible for the treaty benefit. That's what the department says under section 197, right? Once the 197 is rejected, company anyways go with the transaction, they sell without paying any capital gains. Then they approach the advance ruling, authority for advance ruling, right? Now, authority for advance ruling makes very interesting remarks with respect to this. So one thing that we need to note is that with respect to admission of AAR, advance ruling, if it is a case prima facie designed for tax avoidance, they will not admit that case, basically, right? At the threshold itself, they will say that this is a case designed for tax avoidance, I am not going to take up this case, right? So that's what they said in AAR. They say that, okay, what you have tried to do is, the Mauritius entity is not there. These are all puppet directors you have, right? The Charles Coleman person is the only person who is going to, make all the shots, he's taking all the decisions, etc., right? Therefore, I'm saying that you're not eligible for treaty, one. Anyway, this structure entirely is designed for tax avoidance purposes. I'm not going to take up this case at all. So section 245R, subclause 3, they say that I'm not going to take up this case. But they went ahead and said that on merits also you're not eligible for exemption, right? It's like this, okay, you go and ask for something, they say that I'm not going to take up the case. But still I will make a remark saying that you are not eligible for treaty benefit. That the second part was not required, right? But they went ahead and said that, okay, on merits of the case also, it looks very much that you are not eligible for treaty benefit. And in concluding that, they make a very interesting remark. You look at India-Mauritius treaty, right? Article 13, subclause 3A, right? It says that gains arising from alienation of shares acquired after 1st April 2017 shall be taxable in the state in which the company whose shares are being sold is situated, right? Basically, after 2017, it gives right to India to tax it, right? So what it implies is that prior to 2017, whatever shares you have acquired, whatever shares Mauritius entity had acquired, right, it is not going to be taxed in India. That is what I say. It's very clear in this case that it was acquired prior to 2017. Now, what they say is, this is not Indian shares what you have sold. You have sold the Singapore shares. So what has happened? Tiger Global Mauritius has sold Singapore shares and not the Indian company shares. They therefore say that you are not even eligible for India benefit, right? So they say all this, and then they say, no, see, it's a prima facie case for tax avoidance, therefore we are going to take up this case. So indirectly they have taken up the case, or merits they have tried to conclude it, and on the other hand they went ahead and say, see, this is the case we cannot take up, right? So this is what happened at advance ruling, right? Then the case came before Delhi High Court. We are at that stage where Delhi High Court has given a ruling on this matter, right? Now what happened, so there are certain things which we have to be very careful, which we must know in terms of the income tax provisions, the treaty provisions, etc. You are free to maybe refer the income tax rules if you have in your mobile phone, etc. That will be very helpful. There are a couple of provisions that we need to be very aware of, right? One is the Article 13 to India-Mauritius Treaty, right? Article 13(3)(a), 3b, and Article 13(4). Basically, it says that when a Mauritius entity sells the shares or acquired the shares prior to 2017 in an Indian entity, and if it is going to sell at any time, there is not going to be any tax in India, right? That's what they say, right? If it is acquired after 1st April 2017, then it will be taxed in India. If it is going to be sold prior to 2019, 50% tax will apply. After that, it is going to be 100% taxation, right? That's what the treaty provisions say, right? Then there is Article 27(a), limitation of benefit clause. It says that with respect to claiming benefit under Article 13(3)(b), there are certain conditions which you'll have to follow. You should not be a shell entity, you should not be a conduit entity, etc. What is shell entity, what is conduit entity, etc. is also defined there. Basically, you need to have certain minimum amount of expenditure incurred in that entity. All those things are there. That is the second point. Third point is to do with section 90 subsection 2a. We must have heard about GAR, General Anti-Avoidance Rules. So GAR provisions under the income tax says that it will override the treaty provision. So generally it goes like this. You have the income tax provisions, you have the DTA, right? So DTAs generally override the income tax provision because of the specific provision says that to the extent treaty is beneficial to the SSC, treaty provisions will apply, right? But GAR is an exception to it, right? GAR provisions very clearly say that GAR provisions will apply notwithstanding that treaty provisions are beneficial to the SSC, right? Therefore, it's like GAR gets the first priority, then comes treaty, and then comes the income tax provision, right? This is section 90 subsection 2a. Now, with respect to GAR applicability, you need to be aware of rule 10U 1D and 10U 2, right? Basically, even for GAR, you have grandfathering provisions. It says that if you have made an investment prior to 2017, right, GAR provisions will not apply. There is a very, very peculiar sub-rule 2 to 10U, which says that without prejudice to 1D, 10U 1D, if there is any arrangement made, irrespective of the date on which the arrangement is made, GAR provisions will apply. All these are these are the crux of the issue that is pending with Supreme Court. Maybe if you have the actual provisions in hand, it will be very helpful to you to understand as well, right? I'll give you an overview of what is the issue now, right? These are the provisions, and then you'll have to be aware of 4 or 5 circulars that have been issued by the CBDT. Most popularly, circular number 789, which was the subject matter before Supreme Court in Asadi Bachao ruling, where Supreme Court kind of blessed the circular saying that no, this circular is good, right? There the CBDT came very specifically said that if there is a Mauritius shareholder is going to sell the shares in Indian company, it is not taxable in India, right? Very categorically they say that it is not taxable in India. We are looking at a story of FIS investments into India, right? Very, very quickly the economic aspects to it as well, right? We are talking about 1990s post-liberalization, right? India was wanting for funds, right? And then it turns to Mauritius. Now look at the amount of investments that has come into India through Mauritius. Out of the entire FII and FDI, it is told that approximately 25% of the entire money that has come into India from outside India is through its Mauritius route. And everybody knows that monies coming through Mauritius are not coming from Mauritius. It has come from somewhere else. It has come through Mauritius, not come from Mauritius, right? So that is also something that we need to be very careful of, right? All these things everybody knows. And collective investment vehicle kind of structure is also known to everybody, right? So you have a offshore entity which collects all investments from everybody outside India, outside their own jurisdiction, and then put the money into one entity. All these are known structures to us, right? Since 1990s, Mauritius has been such a good partner to India in terms of investment. That is known to everybody. Even CBDT has acknowledged it, and they say that, see, if you are going to make investments from Mauritius into India, I am giving you capital gain exemption. Circular 789 says that to get capital gain exemption, if you produce tax residency certificate, TRC, if you produce TRC, then it means that it is a sufficient evidence that you are the resident of Mauritius, therefore you are eligible for treaty benefit. They say that, they stop it, and they have not revoked it, right? So the circular is still in force, circular 789. There is one more circular, circular 682, right? It kind of says the same thing. Now, fast forward to, we are talking about 1990s, right? So therefore you go issue a circular saying that I'm not going to touch you at all monies come into India, etc. So greater FDIs, FEIs has come to India through Mauritius route, right? And then in 2012, 2013, they tried to introduce a provision, section 90 subsection 5, stating that TRC is not going to be sufficient. It is a necessary evidence, but it is not going to be a sufficient evidence for you to claim treaty benefit, right? This was proposed in Finance Bill 2012, right? When the moment it was proposed in Finance Bill, there was a huge ruckus, right? They said that no, this is going to cause a lot of problem, and then Ministry also kind of felt, okay, it is not going to be very good for India if we are going to go ahead with the provision. Then they come out with the press release, and then they say that we are dropping 90 subsection 5. We are not going to introduce that. It is giving a feeling that TRC may not be sufficient. Assessing officer might go after and beyond TRC. That is not what we intend to do. Therefore, we are not going to introduce that provisions into the Act. Till now, 90 subsection 5, the condition that TRC is a necessary but not a all comprehensive evidence, that has not found place in the Indian Income Tax Act. Therefore, still circular 789, which says that no, TRC is a sufficient evidence to prove residency and beneficial ownership, that still stands good, right? These are some of the provisions and actions which would be very relevant for us. And also you have now the protocol signed between India and Mauritius trying to introduce principal purpose treaty. In fact, it is signed, it is yet to come into picture. What kind of implications it will have, etc., we'll have to see. Okay, so these are the entire gambit of provisions and history that has happened. We'll try to map it to what department wants to achieve now, right? So on one hand, you have CBDT pushing for lot of investments into India through Mauritius by giving capital gain exception, etc. On the other hand, you have revenue arguing that you are not eligible for treaty benefit in certain cases like this. There are a lot of cases. You talk about Blackstone, which is also pending with Supreme Court. All those cases are there where the investments are through Mauritius. In fact, Delhi High Court in one full para talks about why investments through Mauritius not anathema, right? The moment you see Mauritius, right, there is this kind of feeling with the assessing officers that okay, there is something bad, there is something fictitious there, etc. There is nothing to do with. So Delhi High Court says that you look at the history, you look at the commercial reasons behind why investors choose Mauritius. CBDT intentionally wants to give benefit, that is one, and they have clearly laid out TRC is a sufficient evidence for you to go ahead with that, right? Mauritius has lot of treaty networks. For example, they also have very conducive investment environment, political stability, etc. All these are also the advantages for the investors to come through Mauritius. And you don't have to look at in a way that okay, tax is the only parameter for which they consider Mauritius route, right? And we also have on one hand we have McDowell's case, Asadi Bachao, which all kind of blessed treaty shopping. There is a blurred line between what is treaty shopping, tax avoidance, tax evasion, tax planning, etc. All these are there out there, right? It is not yet settled, right? So these are there. Now comes Delhi High Court. Now Delhi High Court actually holds the matter in favor of the assessee. They say that you are eligible for treaty benefit. Couple of things that we'll have to, not in detail, I don't want to go. These are the fact patterns. I'll just impress upon a couple of matters that are there. Now we talked about the point where there is Charles Coleman who is making all the investments, etc. Right? One point that revenue has completely missed is that on facts they thought, and they had made substantial arguments saying that Tiger Global Management LLC is the shareholder of Cayman Islands. They had made all submissions stating that, see, above Cayman Islands, you have only Tiger Global Management LLC. And above that, you have one person who is sitting, Charles Coleman, right? Factually, that is wrong. And Delhi High Court very vehemently points out, and this could be one of the turning points for Delhi High Court to come to conclusion, which it elaborates, saying that revenue has proceeded on a factually wrong case, right? Actually speaking, there is no equity from Tiger Global Management at all, neither from Charles Coleman, Stephen Boyd Baird, right? They say that the equity has come from private equity funds. The Tiger Global Management LLC or Charles Coleman, they are only investment managers. They are only advisors to the entity, right? They have not invested in any of the entity. Therefore, that is a wrong premise you have started with. One. Next point. They say that there is a LOB clause, Article 27A, limitation of benefits. We saw that what is a shell company, what is a conduit company. If you incur certain percentage of certain amount of expenditure in Mauritius, you are not treated as a conduit company, right? On the facts of the case, that Mauritius entity has incurred minimum expenditure in that entity, right, in Mauritius. Therefore, they say that you have satisfied the LOB clause, right? It means that, see, I am giving you one benefit subject to satisfying this. That is the LOB. So Article 13(3)(a), 3(b)(4) is the benefit I am giving it to you, grandfathering the capital gains exemption, subject to satisfaction of LOB clause, provided you are not a shell or a conduit company. You have satisfied the test. One. Next, you have also produced me the tax residency certificate which is issued by the Mauritius authorities, right? These are the two conditions that are there. You have satisfied both the conditions, right? Can the revenue then put additional barriers in the form of, be it GAR, in the form of being head and brain test, whatever it is? They say that the revenue authorities cannot put any additional barriers. There are two conditions you have to satisfy. You must produce TRC as per Circular 789. You have done that. Then you will have to satisfy the LOB clause. You have done that as well. So therefore, there is no additional barrier that can be put to you, right? So this kind of concludes as to what Delhi High Court wants to say. There are a lot of other things they have said, right? In fact, revenue takes a very interesting argument in Rule 10U to say that GAR provisions are applicable in this case. See, you look at from this perspective, what kind of a case revenue has, right? One, you will have to prove that TRC is not the sacrosanct. Beyond TRC also I can go. In fact, in Vodafone case, Supreme Court says that you can travel beyond TRC provided there are certain conditions. It is a sham transaction, there is a colorable device, there is a conduit company, it's a tax fraud case. All those cases you can go beyond TRC as well, right? Supreme Court has blessed that. So revenue tries to heavily rely upon that. Only thing is the factual point, they have not proved that it is a conduit company or it's a shell company or it's a tax fraud case, right? So that is one. So they will have to prove that TRC is not the only sacrosanct evidence that you need much more beyond. You will have to prove the substance, etc. One. Next, they will have to prove that indirect transfer provisions are applicable even under the treaty. Now, treaty talks only about direct transfer provisions. The amendment that was made under the income tax law was an amendment stays in the domestic law. It has not amended the treaty per se. So they will have to cross another threshold of proving that indirect transfer provisions are applicable even to the treaty, which is going to be very difficult. Andhra Pradesh High Court in Sanofi Pasture said that it is not applicable in the treaty scenario, right? Third aspect is they will have to necessarily invoke GAR provisions. In fact, if they are eligible to invoke GAR provisions, then they can come out of all the other problems. If they can say that GAR provisions are applicable, it is not grandfathered, then they can always say that Singapore entity, Mauritius entities are interposed entities by virtue of the power that is vested with them under GAR provision in section 97, 98, 99, 100. They can very well easily say, or at least they would have a case to say that Mauritius entity is an interposed entity, I am going to disregard that entity, right? TRC is not the only sacrosanct entity. All these opportunities, all these arguments for the revenue would open up if they can prove that GAR provision is applicable. But unfortunately, they struggle to prove it on two counts, right? One is that, of course, GAR provision contains grandfathering provision. They try to take a very interesting argument of Rule 10U1D talks only about grandfathering of investment. It does not talk about grandfathering of arrangement. And then they say that there is a distinction between investment and arrangement. An investment is a simplicitor investment. So I am a Mauritius entity, I invest in an Indian entity, this is a simplicitor investment, right? But there is a private equity fund, under that there is a Cayman Island, there is a Mauritius entity, then there is a Mauritius entity, then there is a Singapore entity, then you have Indian entity. This is not a simplicitor investment, right? This is an arrangement. Therefore, they say that what is grandfathered is a simplicitor investment, I understand, but not in cases of arrangement. They try to take this argument to say that GAR provisions are applicable. Delhi High Court says that this looks very fancy argument, right? If I were to bless this argument, all other investments, see, investment is a subset of arrangement, right? So they say that if I were to accept this argument, it means that all cases would fall under an arrangement. I cannot bless this. Therefore, they say that no, I am not going to take this. Therefore, GAR is out of the equation for that one ground. The second ground, and that is what is under fire before Supreme Court, is that did the Delhi High Court at some point in time, either directly or indirectly, with due respect, did they say that GAR provisions cannot apply in a case where you have satisfied LOB? Right? Did the Delhi High Court say that? So it's not very, it is not coming explicitly in the ruling. They say this: if you have satisfied LOB, if you have produced TRC, there is no additional barrier. Do they mean that you have satisfied LOB? You are as per treaty, you are claiming benefit under treaty, GAR cannot override treaty. Is that what they are saying? Does it mean rewriting of the law? With due respect, this has to be tested before Supreme Court. In fact, advocates and counsels who are appearing for the assessee are actually saying that GAR provisions do not override treaty. They are saying that GAR provisions override treaty. They are saying that GAR provisions do override treaty. All that we are saying is that there is a grandfathering under GAR. Therefore, we do not want to touch. Right? So, whether Supreme Court will come back and say that in a scenario where LOB is satisfied, TRC is satisfied, GAR provisions cannot be invoked, that is something that we will have to see. In fact, circular number 7 of, if I am not wrong, 2017, CPTT says that, it's a question FAQ, they say that in a case where there is LOB provision under the treaty and there are GAR provisions, whether GAR provisions can apply. Right? They say that generally it can apply because because LOB is a specific provision. It cannot apply in every scenario, right? But if it is sufficiently covers all scenarios under which anti-abuse can be prevented, then GAR will not apply. It's a very vague statement from CBT in that matter. But then the generally accepted principle is that section 90 subsection 2A starts with non-obstante clause. It says that notwithstanding the above, GAR provisions will apply. Right, will apply even if the treaty provisions are beneficial to the assessee. Right? So therefore, that is something that will come under heavy scrutiny before Supreme Court. We'll have to wait and see what the Supreme Court says on that. Right? The other aspects that will have to be that will be very interesting to see before Supreme Court is whether at all beneficial ownership provisions apply for capital gains. Right? Look at this. Look at dividend article. Look at royalty. Look at fees for technical services. All these contain beneficial ownership clause. Right? Capital gains does not contain beneficial ownership, treatment or the condition at all. Therefore, this point has not been addressed by Delhi High Court. Nobody seems to have argued that beneficial ownership is not applicable in a capital gain scenario. But this might come up, before the Supreme Court. This might come up, right? Concluding arguments on this is. Very interestingly, revenue comes and says that the circulars under sections, circulars number 789, 682 are applicable only for FIIs, it's not applicable for other Mauritius holders, etc. All these will have to be tested before the Supreme Court. But the larger point that we need to be aware of is that with protocol introducing principal purpose trust into India-Mauritius treaty, how will that interplay with the future arrangements that you will do? Right? There is circular number 1 of 2025. CBDT says that where there are specific anti-abuse provisions, like in India-Cyprus treaty or India-Mauritius or India-Singapore treaty, that will not, GAR will not impact those cases. It's not a very conclusive statement, but it gives a feeling that in a case where there are specific LOB provisions, it is PPT. Where there are specific LOB provisions, PPT will not apply. That's the feeling that you get. So even after the protocol coming into the picture, we might have a scenario where you are, one, not falling within GAR, two, you are not even falling within principal purpose test. Ironically, very, very ironically, the LOB provision seems to be not at all applicable in this case. The assessees have been saying that I have satisfied the LOB clause. Right, I am not a shell company, I am not a conduit company because I have certain expenditure I have incurred, etc. Article 27A of the India-Mauritius Treaty does not even apply to 13.4. We are claiming exemption under Article 13.4, residual clause. But Article 27A applies only for Article 13.3B, which talks about 50% exemption in case where you have acquired the shares after 2017 but sold before 2019. Therefore, the premise is that assessee and even the High Court, with due respect, have held that you have satisfied LOB provisions, therefore GAR is not applicable. Even going forward, LOB is there, therefore PPT is not applicable. But the first principles on LOB, whether LOB itself is applicable in this case, is something that Supreme Court will have to say in this matter. It will say, it is argued by revenue that LOB itself is not applicable in this case, right? So these are some of the principles that comes out of the ruling, right? I mean, this is, if you want to talk about the ruling, we can talk for 5-6 hours as well. But then this is an overview picture of what lies with the Supreme Court and what we can expect out of the Supreme Court. Any questions on this before we go further? No question. Right. Very quickly, I'll run through. IAT International. So this is a very, very typical arrangement you will see. In hotel industry, you have this kind of a structure, right? So there are owners who own the hotels. Basically, they are owners of the land, owners of the building, etc. Then you have MNCs like Hyatt, like Sheraton, etc., who tie up with the owner, basically. And then they say that, okay, you remain the owner of the hotel, but I will do the entire operations for you. So wherever you go, whatever hotels you see, particularly in IAT cases, you will see that the owner is somebody else, but the management of the hotel is done by somebody else, right? So in this fact pattern of the case, right, there is a Hyatt Regency Hotel in Delhi, right? So that owner is an Indian entity, the owner of the hotel, etc. They enter into an agreement with Hyatt UAE, right? And then they say that Hyatt UAE basically will assist the entire operations, etc. Right? What are the processes, what are the policies, etc. So they term it as Strategic Oversight Services Agreement. We call it as SOSA, right? They say that under SOSA, I will give you strategic services as to how you have to run the hotel. I will tell you everything, right? Then they say that this is strategic services. I also have an Indian entity which will provide you hotel operation services, basically day-to-day management, right? So you look at the structure. The structure is like this. We do not have the structure. So basically the structure is like this. You have the owner entity, basically the owner of the building, the hotel. Then you have Hyatt UAE, which is saying that I will provide you all strategic services, overseas SOPs, guidelines as to how to run the hotel, what is the branding that you'll have to do. You can use my trademark, Hyatt trademark also, right? So basically, it's a complete strategic know-how agreement that they have. They say that, okay, you will run based on the policies and guidelines that I give to you, right? This is on the strategy level. Then they also have an agreement with the Hyatt India entity. Hyatt India entity will help you in day-to-day operations. So the role of the owner in this is basically to own the building, right? Everything else is at the prima facie level. If you see, everything else is done by the UAE entity as well as the Indian entity. This is the entire structure. Now the point here is whether Hyatt UAE has any PE in India. Whether the hotel premise where they give the directions, instructions, policies, SOP, does it mean a PE for Hyatt UAE, and therefore there is a tax attributable to the PE, right? Income attributable, therefore there is a consequential tax. That is the thing we'll have to, that is what revenue contends. In fact, their first contention is that if you all know that in India UAE treaty, there is no FTS clause. There is no fees for technical services clause. Now imagine this scenario, right? the hotel is there. There is an entity which pays the service fee to the Hayat UAE for providing all the strategic services, right? It is not taxable in India. There is no withholding tax in India because India UAE treaty does not provide for a FTS clause. It is not taxable. You are saying that there is no PE in India, therefore it is not taxable as business income also. So whatever is earned by Hayat UAE is not taxable in India. There is no withholding tax, there is no net based tax. It was neither taxable in UAE because at that point in time there was no taxation at all in UAE. So therefore the point here is that it is not getting taxed anywhere. This is the kind of structure that they had in place, right? Now the revenue authorities come and say, there are two arguments that I am going to make. One, whatever you pay to Hayat UAE is a royalty, not even a fees for technical services, it's a royalty. That is one argument. Second argument, you have a fixed place fee in India, right? Very succinctly, let's understand the difference between a service fee and a fixed place fee, right? Under India UAE treaty, there is a service fee clause. Now, what is a service fee, right? Basically, if a foreign entity, right, provides some services, as part of that they send some employees to India and all this stuff, they render some services. If they cross a particular threshold of number of stay of days in India, then they establish a service fee in India. Under India UAE treaty, the threshold is 9 months. So if the employees come to India, right, employees of the foreign entity come to India, they stay for a period more than 9 months, they establish a service fee in India. In this case, on fact pattern, they had not stayed for more than 9 months. Therefore, they do not consume service fee, right? Now the bigger picture. You have a very open-ended fixed place fee clause. Fixed place fee, what does it say? Right? Article 5 of India UAE treaty, it says that fixed place of fee is established when the foreign entity, right, as a place of business through which it partly or wholly carries on business, right? So you need to have a place of business in India. Let's put it into context between UAE and India. The Hayat UAE entity needs to have a place of business in India through which it should carry on its own business either partly or wholly, right? This is the test that you will have to satisfy to say that there is a fixed place fee, right? Whether it has a place of business in India, that is the question, right? Whether the hotel, will it be construed as place of business of the owner, which is owning the hotel, or will be treated as place of business as of Hayat UAE, right? That is the entire picture now that is the moot question here, right? There is one more aspect to it in transfer pricing, we'll come to that. But the point here is that I could very categorically say that it is not royalty. We will not go into that. It is not royalty at all. Basically, it is a service provided, therefore it is not royalty. One of the arguments of revenue was that they were also using the Hayat trademark. The owner was also using the Hayat trademark. They were making payments for that. It's a composite payment for the services. ICOT says that, see, it is inextricably linked to the services that they are providing. Therefore, it will be treated as a service only and not separately as royalty. The case is closed there. There is a service payment, not a royalty payment. The question now is with respect to whether there is P in India or not. We have already told that there is no service P. We are only concerned about fixed place P, and very particularly we are concerned about whether the hotel, will it be treated as place of business of Hayat UAE. We are all very clear that it is the place of business of the owner because he owns the hotel, he runs the hotel. But whether can it be construed as place of business of the Hayat UAE, right? Now, you look at OECD commentary on this, you look at Formula 1 ruling on this, EFIN's ruling of Supreme Court, etc. The test here as to whether it is a place of business of the entity or not is the disposal test. If the foreign entity has the place of business at its disposal, then it will be treated as its own place of business. What do you mean by disposal test? What do you mean by at its disposal? Does it mean that it should own the place? Does it mean that it should have rented the place at least? The OECD commentary as well as the ruling say that neither of them is required. It need not own the place. It need not even have taken rental place, right? It need not even have legal control over the place. Even if you have taken some place illegally, there is an illegal encroachment, for example. Even in those cases, you will satisfy the disposal test provided you have sufficient control over the place. If the place is at its discretion. Now look at the SOSA agreement we talked about, right? Under the SOSA agreement, it's very clear case, right? They say that Under the SOSA agreement, basically they say that we will provide you all policies, guidelines, etc. that you will have to follow. You will have to follow IAT's operation policies, IAT's standard of quality. We will give you SOPs, etc. you will have to do, right? We will send employees on a temporary basis. Whenever required, we will send employees. In fact, the general manager of the hotel that you run, we will employ. Right? They say that in consultation with you, a general manager of the hotel, we will employ, right? In consultation with the owner. So there are a lot of weightage given to the IAT UAE in terms of what they can do. It gave a feeling that it had some kind of a control over the place. Basically on two counts, right? One, they can send employees at their discretion. They can send employees on a temporary basis. Okay, in fact, in that case, 6 employees came to India. They stayed for 150 number of. They are all senior manager level employees, right? They'd come to India. The High Court found that based on the tribunal's fact finding that the place was at the discretion of the senior employees who had come to India. That they can use it for their own purpose. And in fact, they also went ahead and said there is a little doubt as to whether the senior employees might have used the place for some other business as well, right? Some other Hyatt's hotel as well. It need not have been necessarily that particular Hyatt. They could have sat there and did some other Hyatt's hotel business as well. Therefore, it seems that they had sufficient control and discretion over the place, right? Therefore, High Court held that you have satisfied the fixed place fee, right? So this is again pending with Supreme Court now, right? It is reserved for judgment. One more very nuanced aspect is there. In this case, peculiarly, Hyatt Global, Hyatt UAE, basically, they had incurred loss at their global level, right? Now, it's a very, very interesting argument to make, right? What does Article 7 talk about? Business profits. It says that if an entity, foreign entity, right, the profits of the foreign entity will be taxable in its resident state. There is no doubt. But the profits of the entity may also be taxed in the source state if they have a permanent establishment there, right? So it may also be taxed. The profits may also be taxed in India if they have a permanent establishment. Now the argument that assessees take is that there is a loss, right? What we are talking about, there is an overall profit, right? The profit attributable to PE may be taxed in India if there is a PE in India. Now we are talking about an overall loss. A portion of the profit can only be taxed in India if there is no profit at all. Then nothing can be taxed in India. That is the argument. In fact, in Delhi High Court, Nokia case, they blessed this argument. They said that correct. If you have a global loss, nothing can be attributed to Indian operations, right? Interestingly, in this argument, Delhi High Court takes a detour and says that this does not seem to be the correct law. They referred to the larger bench. They said that PE has to be looked at independently. They say that, okay, at overall global level, you might have made losses. But we have to look at PE as an independent entity. As an independent entity, whatever operations, whatever functions they have done, whether they are eligible to make profits or not, that is what you will have to see, right? So imagine this scenario, right? From Indian PE operations, you might have made profits, assuming, right? You have UAE entity which had made losses. On a cumulative level, it could still be a loss, but does not mean that there is no profit attributable to the PE. Right? Therefore, they say that there is no argument that if it is going to be global loss, therefore there is no attribution in India. That argument is not there. They refer to the larger bench. The larger bench also overturned the Nokia erstwhile ruling, and they said that PE has to be looked at an independent basis. Right? Therefore, whatever is the profit attributable to the PE on an independent basis, irrespective of whether the MNC has made at global level, if they had made losses, irrespective of that, the profit must be attributed to PE based on the functions they have performed. Right? So that is also pending with Supreme Court. All these matters are currently pending with Supreme Court. We'll have to wait and see how the Supreme Court ruling comes out. Right? That's it from my side. Thank you. I'll hand over to her on transfer pricing cases.
We try to take only the case laws which are very important or which is very current to ensure that the knowledge is also there for the audience to say that it's all available there. Okay. Uh, what we are actually for transfer pricing, basically, we have a lot of things in terms of comparables, where we get into a lot of arguments at the transfer pricing scrutiny assessment stage, whether this is so and so company is a comparable or not a comparable, whether functionally they are comparable, whether comparable uncontrolled price has to be used, or whether transaction net margin method has to be used. If an other method is used as a qualitative parameter, because none of the other methods can be used, like cup or resale price method or cost plus method or TNMM, then is it logical or is it reliable of the company to just use a business reasoning to substantiate its losses? So these are kind of arguments we have always seen, but then now department is also getting into certain areas over and above just talking about the comparable analysis or the cup analysis or the TNM analysis. They are also going into other areas as part of transfer pricing where we need to be aware of, and that's exactly why we have taken those case laws which is not with respect to the comparable analysis, because this is a constant war which happens wherein there is a set of comparables which is taken by the SSC as part as their comparable, whereas the department comes out with a different set of comparables saying that either maybe they are not functionally there is a turnover filter they are giving it. Of course, related party filter is something both of assessees and income tax department agrees upon, but there are other filters where they could be, department also sometimes uses a filter called export turnover filter, or it also uses a filter saying that we would see the net worth of the organization. So there are several arguments with respect to the comparable analysis. So that's something which is a never-ending point which is going on and which will continue also in future. But there are also other areas where department is getting into, they are getting into the mere definitions of what is happening in transfer pricing, and this is one such case. See, often there is an argument when there is a transaction between two companies, one in India and say the other company is in US or UK or UAE or whatever. Those two are associate enterprises, need not be holding company, because also your transfer pricing talks about whether it's control management, share capital, whatever methodology, and they also given a whole list of things, what are the other things and conditions which has to be satisfied to take it. But then never, there have been always a doubt in the mind of the assessee when you're talking about a holding company and a branch or a project office. Because as you know, when a holding company, a foreign company is coming over to India, they have two methods to also have it. They can have their own office in the terms of a branch office or a project office, and they can set up a subsidiary. So subsidiary takes the character of a resident. So it becomes, it enjoys all the benefit of what a resident company in India which is registered under the ROC gets. Whereas a PO or a branch office, for all practical purposes, is an extended arm of the holding company. So if there is a holding company which is elsewhere in Singapore and that holding company establishes a project office or a branch office, it also pays the taxes at the, as a foreign company. So the tax rates are also higher. It doesn't come into the 25% category, it comes at the 35% category. And hence, always it's constitute that any transactions between the holding company and its branch office is always at arm's length, because it is doing its own. The holding company, whatever transaction it wants to do, it is doing to its PO. And it is also taxed with the same, the PAN is the same for the holding company, the branch office and the PO. And also again, if you are talking about how the taxability happens, whether the holding company enters into any transaction with Indian vendors or customers, or the PO or the branch office enters it, it's all reported in the same PAN, and then it's tested for arm's length. So the interesting question comes in, if there are transactions between the holding company or the associated enterprise, of course, in this case the holding company, because holding company has the extended arm which is the branch office or the PO, will that also be tested for arm's length? So often there has been a lot of interpretation issues there, wherein assessees have taken a view that it's because its own account. So any transactions between the holding company and the branch office should not be tested for arm's length pricing, for the simple reason that whatever taxes come in, again the holding company is what is going to bear that. So there's no question of testing the arm's length pricing in this. So this was very clearly taken care of in this case. The background of the case was a Chinese company, they entered into multiple contracts with the Power Grid Corporation in India, which included an offshore supply and onshore supply. You are aware that what is an offshore supply and an on-site supply. So it could be done by an Indian company in India, will be on-site. Offshore could be some supplies could also happen, or some fee for technical service can also happen from the overseas holding company. So for onshore services, they had a PE here and the PO provided services here. The head office in China has made or received certain payments on behalf of the PO, as the PO did not have a bank account in India at the relevant point of time. This normally happens. Whenever a PO is set up in India, sometimes in the initial period, there might not be a proper bank account, so they will ask the head office to operate it. So the assessing officer or the TPO held that there was an international transaction between PE and head office. PE was undercompensated and had incurred losses. TP provisions apply and hence ALP has to be there. Because what they constitute here is, there could be transactions, say for example, in the initial period they didn't have a bank account. So the sales receipts all come to the head office bank account. So the losses, the expenses are incurred at a later point of time, then there is a loss in the subsidiary or the PO. In this case it's a PO. Then they said that it is the losses are coming only because of all this. Reimbursements what is made by the head office to the project office in India, and hence you should have tested for arm's length principle. So let's go to the provisions of China-India DTA on business income. Article 7.2 talks about where an enterprise of a contracting state carries on business in the other contracting state through a permanent establishment, there shall in each contracting state be attributed to the permanent establishment the profits which may be expected to make if it were a distinct and separate enterprise. So this is what is very important, whether it is a distinct and separate enterprise, and that's also the argument the assessees normally take. The PO or a branch office which is established in this country is not a separate or distinct enterprise because it's an extended arm of the head office itself, and hence TP provision should not apply. Engage in the same or similar activities under the same or similar conditions and dealing wholly or independently. This is common to all the business income definition. So associated enterprise, again in Article 9, where enterprise of a contracting state participates directly or indirectly in the management, control or capital, and the same persons participate. So this is also very much the same. And if you see our associate international transaction definition, it very clearly says it means a transaction between two or more associated enterprise, either or both of whom are non-residents in the nature of purchase, sale or lease of tangible or intangible. So here either or both of whom are non-residents. But in this case again the assessees could take an argument here saying that the PO is also constituted as a non-resident and hence they have been paying a tax at a higher rate. Right? If they are considered as a resident of India and they are getting the benefit as a resident of India, then the tax rates are to be lesser. So since it is saying that either of whom are non-residents, or so even if I consider the PO as a non-resident, it is not a resident obviously of India. So because the definition says either or both of whom are non-residents. So one person can be a non-resident, other person can be a resident, or both can be non-residents. So that is where the entire thing comes in, because that's where it is there in your international transactions. So again, meaning here it also says that deemed to be an international transaction entered into two associate enterprises if there exists a prior agreement relation to the relevant transaction. So we are not even talking about only transactions. So deemed international transaction may also come in if there are any prior agreement between the entities. So transaction may also be an arrangement or an undertaking or an action. So here the assessee's contention here, he said between the transaction between the head office and project office, it is only internal fund movements, it's not income generating activities, and hence it should not be tested for arm's length. The actual commercial transactions are between the PO and unrelated parties. That's the actual fact. Because the fact is the bank account is not there, so they had to write it, but it was only with a external party, external customer and external vendor. As per section 90, the provisions of DTA override domestic law, and article 9 they talked about HO and PO are not distinct legal entities. That's the point it was talking about, separate and distinct legal entities, and PO is not a resident of India for DTA purposes. Therefore, transfer pricing provisions is not applicable. So why that is very important? The moment I say that transfer pricing provisions are applicable, then I need to also test the arm's length transaction between them. Sorry? No. Here we are talking about the TPA provision, TP provisions, right? Here one of the things what we are having there, it says that either or both. So I can have one person as a resident and the other person as a non-resident, or two non-residents can also transact. Then I need to also test it as a arm's length pricing. So that is the problem here. So in the DTA, provisions are taken to say that whether it's a separate and distinct entity. That part alone they wanted to highlight, and hence they have taken the DTA provisions. Because see, even though DTA and TP provisions go hand in hand in some of the cases, there could also be a subtle difference between them. So DTA is applied for a particular thing on the taxability, whereas arm's length pricing is much more than. So even if it is going to be something is saying that there is no withholding tax which is required on a particular transaction, so even in the previous case what we are talking about, the losses or a profit, we need to also see whether the attribution, whatever is the profits is there, it's at arm's length. So that's also something which has to be taken for TP provisions. So TP provisions has a unique nature of taking whether the transaction between the entities are at arm's length. So that's exactly why that was very clearly done. Of course, the DTA, the reference was given to say that it's a separate and distinct entity. For that purpose only they are taking it, saying that the PO is not a separate and distinct entity because it's forming part of the HO's operations per se, and it's an extended arm of the HO, and it doesn't get any benefits as a resident in India, and hence they should not be applied for. So this is revenues contention. They said you cannot deal with yourself, does not apply, because this is the contention again the assessee has made, because it said that it's not separate and distinct. You are not, so one and the same, HO and PO are one and the same, and hence you cannot deal with yourself, was the argument what the assessee said. So revenue contention was 92A is not applicable to the case, this one enterprise is not participating, but it is to be noted between an enterprise and a person who is not an associate enterprise may be deemed to be transaction. So they said there is a prior agreement, there are so many things which is to be taken care of, and hence you cannot go by the argument that you cannot deal with your own self, and hence TP provisions are applicable. So the key question, what was the key question? In an independent party scenario, would an enterprise route its receipts and payments to a third party? Will we do it? Normally it's not. Just because it's an head office and PO only, it's been done. Otherwise, if it's going to be a third party, will any third party get their bank receipts to be done with a other party? So profits that will be attributed to PE shall be the profits that the PE might be expected to make if it were a distinct and separate enterprise. So these were all revenues arguments, but what is the key question is whether or not the transactions between a foreign enterprise outside India and its Indian permanent establishment can be considered as international transactions. This is a big debate. And this is an interpretation issue. I think department has come out very clearly here saying that you need to do, because there could also be a situation where there is an Indian holding company and it has a project office or branch office in say Malaysia or Dubai or Singapore. What do? Are we going to test them for arm's length pricing from the Indian perspective? That's again a question. We can take an argument because the Indian company, if there is a PO or a branch office which is established, the entire profits is booked in India, because you take the financial statements, including the HO and the project office will be taken together for offering to tax in India, and hence you don't need to test. But that is not the case in this criteria, because here the head office is outside and India has a project office. So what happens is, that is again an interesting point. Maybe from that country's perspective, they might say that TP provisions will apply, for the simple reason that if a project office is in India, you pay the tax on the profits only for the project office operations. You don't bring into your head office details here, what is the profit which is getting attributed from the PO. Of course, let's not get into that, whether the contract is holistically taken, including the PO's operations. Are we supposed to see the global contract? But strictly speaking, if head office is not providing any services or goods from their jurisdiction, and the PO is there in India, which is doing the complete operations, then the PO operations alone has to be tested here, and it will be taxed to India in PO at the foreign entities rate. But if it is going to be a head office in India, which is a holding company, and then you have a project office in any other country, what happens is you take the consolidated profits and pay the taxes in India, and hence when you pay a consolidated tax and profits, even if I test it for arm's length, if it's not in arm's length, what do? You're going to increase or decrease it, because your intercompany transactions there, it's going to be one and the same. So whatever you do, the adjustment is going to be the same. Could be an argument to be taken saying that arm's length principle is not applicable if it is the vice versa situation. But again, there could be a possibility that country might come back and say that you are paying taxes only for the project office in my country. You are not taking what is the thing of HO. I want to see what is the transaction between HO and PO. Maybe the HO is taking more and more profits in India. Project office is given only a minimal profit, even though they are entitled for a higher profit, or the attribution of profits is more, could be their argument. So in addition of ITAT was in favor of revenue. They said states that profits attributed to PE shall be those it might earn. Then it says hypothetical separation mirrors the arm's length principle. Both frameworks aim to assess how independent third parties would transact. So they have said in a nutshell it has to be done. This was a debate. At least because of this decision, now it's been at least put to rest that if there is a PO in India and there is a branch office or a PO in India and there is a head office, and if there are transactions between them, that needs to be also tested for arm's length. Okay. So next is we will go to the thing of one more interesting thing what department is getting into it. It is on Sanmina SCI India Private Limited. Now, if you've handled transfer pricing scrutiny assessments, you will see that in most of the companies, department, apart from all this comparable analysis, the CUP analysis, the T&M analysis, they also get into one more point on the receivables, accounts receivable balances. So what happens is, okay, say let's take a hypothetical situation of a company has a credit period which is agreed with its holding company of 6 months, which is returned, it is there documented. The company always gets only after 6 months or maybe 5.5 months or whatever, and they ensure that they get it by the credit period. What happens is, if this 6 months, is it the amount or credit period which is supposed to be there for an unrelated party is something which the department tests. So just because you have a contract, because normally what happens is, practically or administratively, what happens between a holding company and the subsidiary company is whenever the subsidiary company is running short of cash or working capital, the holding company pays the amount back, index it. Even though they have accounts receivable, the credit period is only for the sake of whatever they have it in the agreement. Because obviously, if there is a working capital crunch for the subsidiary company, the holding company has to take care of it, either in the form of an equity or a loan, or it has to ensure that the accounts receivable is paid. So that's the reason the credit period terms are not too much seen in terms of a holding subsidiary relationship, whereas that is very much seen if you are dealing with an outside customer. So if you have an outside customer and you make a sale, an Indian entity is making a sale to an outside customer and the credit term is going to be say 3 months. First of all, will it even enter into a credit term of 6 months? That's not possible. So maximum it used to be 30 days or it could be 60 days at the max. So they will not get into an agreement for 6 months. Nobody is going to just make their working capital affected by a credit period of 6 months, which is normally not the trend in business. So that's one point. Other point is there could also be situations where most of the holding company and subsidiary company, as I was explaining, whenever there is a funds crunch is what they are going to pull the money back to India, there will not be any agreement which is clearly mentioning the credit terms. That's also a possibility. So what they do is, they just orally don't even agree on the credit terms. Accounts receivable service invoices are raised. Whenever they have a working capital crunch, the holding company pumps in the funds into the Indian entity. So there is no credit period. So in these kind of situations, department has now come with a, because they call it as a deferred receivable or a deferred payable, where it says, if there is a credit period or there is no credit period, there is a notional credit period which is assumed. You have to get, if you had been dealing with an outside customer, you would have always ensured, you would have followed up and got the money. The fact that you have not followed up and got the money is only because it's your holding company. That means you are indirectly giving a loan to your holding company, which in the normal circumstances will entertain a percentage of tax as an interest. So they will have to give that interest to this, and that is where exactly what the department means. So what they are doing is more and more, this is also one point, what is happening is, normally we get into what is the kind of pricing they do, whether the price meets the comparable analysis, whether we need to use a comparable uncontrolled price or a resale price method or a transaction net margin method. We don't get into the balance sheet area where you also have an accounts receivable balance and an accounts payable balance. So that is also something which we need to ensure when we are certifying the Form 3CB to see why there is that much of variance. If the credit period is going to be agreed between the holding and subsidiary, whether they are getting the money between the credit period. If there is no credit period agreed, what is the normal time by which they are getting it? Sometimes it could also be possible they will agree on a credit period of 30 days, but then the money will only come after 90 days or 180 days to just meet the RBI guidelines. So it's not only necessary we see the RBI guidelines, we need to also see for the TP purposes there, because department is coming out with this part of treating all this deferred receivables which has not been plowed back into India within a reasonable time as a deferred receivable which has to calculate, notional interest is to be calculated, and addition is made in the TP. So here again, the assessee had outstanding receivables of 4.51 crores, and the receivables declared by the assessee from AEs and non-AEs for, the amount is not very important here. The working capital adjustments already factor in the interest, that's what the assessee's argument was, and merely having receivables beyond the credit period doesn't automatically make it an international transaction. That's what the assessee's argument was. Outstanding revenues contention was outstanding receivable beyond credit period is an interest-free loan. So nobody is going to charge any loan, but if it had been an outsider, would you have charged? But there is again a point there. Say for example, if the subsidiary company is having customers as holding company and also the outside customers, and outside customers they don't charge interest even though they delay it, and holding company they also do it obviously. So then what do we do with this kind of thing? So that's also an argument. They say just because you didn't have it, its interest on outstanding receivables is separately quantifiable, thus should not be considered as part of broader working capital adjustment, was revenues contention. So the key legal question is whether interest on outstanding receivables from AE should be treated as a separate international transaction and attract a TP adjustment, or whether this adjustment is subsumed within the working capital adjustment already made, was the question here. And so the agreed with, they said assessee's operating margin, there was a lot of things which the ITAT said, but incidentally what they are saying is, here in this particular thing there are a couple of arguments we have, not with respect to this case law alone. There could be a couple of arguments which can be taken. One is basically whether there is loan which the subsidiary itself has borrowed. Say for example, the subsidiary itself is operating in a very thin working capital requirements. It doesn't have its own funds. It doesn't have profits, sufficient profits. It is also again having some, it has got some loan, and that loan they are paying interest. But the receivables what they have to get from the holding company, there is no interest. So there could be an argument saying that you have used your funds, outside funds, and you are paying interest. How come you are giving your receivables to your thing as a free of cost? So there could also be an argument the other way saying that if I am having only my free reserves, then I don't need to take my holding company's amount as a receivable which is deferred or in the nature of a loan where interest has to be calculated on that, could be one of the arguments. Of course, there are also other arguments to this. We can also take an argument of accounts receivable balance is there with the holding company. There's also an accounts payable balance with the holding company. If both are there, if accounts payable balance is going to be more than accounts receivable, obviously in any transaction you need to net off, at least for the purpose of settlement, even though you need to get an approval from RBI or authorized banker to do this setting off. There could be one of the arguments saying that accounts payable balance is more than the accounts receivable, hence it's not there. But minded, department takes a view, this accounts payable has to be tested in that country because it's receivable for them. But then we will only test the accounts receivable which has to come to India, could be one of the arguments. So it's better that we ensure that we, even though we do a working capital adjustment, even though everything is factored there, it's a free loan, there is credit period there, we are within the credit period, because there could also be an argument, if your credit period is 6 months, hypothetical case where I said, 6 months is what the credit period is, the department comes back and says that how can you have a 6 months credit period? Who on earth will give a 6 month credit period for an outside customer? So you have to reduce it. So if you don't have a credit period, department takes an argument that the normal credit period should be 30 days. So if you don't have a credit period in writing and the normal credit period is 30 days, so anything beyond the 30 days is added to your income with a notional interest calculation. So the next one is on High Court of Delhi on Commissioner of Income Tax versus AT Kearney Limited. Here it's a management consulting company and it was providing services. I think this is one of the famous thing, at least Chennai, whoever has handled TP assessments, you will be aware of this. Finance management CEO of services, professional development to multinational enterprises. ATK US is a global operations headquarter, provide these services. The assessee adopted TNMM, the TPO determined the services as nil and made additions. Just a small background. See, any MNC for that matter, all multinational companies has a entity which is identified for providing certain services. It could be a bunch of various entities or it could be the holding company itself. What are those services? The services could be, say for example, vendors. A vendor evaluation, vendor rating, what is the price at which you need to purchase it, all this is fixed by each of the entities. But if you do a global pricing, and if you have a global contract, it will be very easy for you to negotiate with the vendors. So if I'm going to get a Microsoft license in India for say 1000, and then I will get across the world all put together is 10,000. So will it make sense for each of the entities across the world to go and negotiate with the vendors and get a pricing for each of this, or will it make business sense to make it across by one entity taking the 10,000 licenses and then distribute to all of them? Obviously, the second one will make business sense. That's exactly what all multinational companies do, and that's exactly the point which is not also understood by the revenue. So that is one. So vendor evaluation is one thing where economies of scale, because of economies of scale, there is a huge benefit which the group derives. So they give one associated company to use this vendor purchasing, whether it could be software licenses, it could also be, say for example, they are manufacturing entities. They also determine the parts from which vendor has to be purchased, and across the globe there is one vendor evaluation which happens, and of course they also say this is the band, you need to take it a price negotiated locally, you can get a discount and then go and agree on the price. That is one. The next thing is on IT services. There are IT services like your backup which has to be taken, which is very crucial. There is disaster recovery plan which has to be there, and there is also, if they have Oracle, SAP and other accounting packages, there should be somebody who has to customize those reports, monitor those issues, whatever is there. So these are some of the services. There is a whole list of services what the holding company does for its subsidiaries in India, and that is getting charged to India with as services rendered by the holding company. So in this particular case, that's what has happened. It's providing services like a finance management, CEO office and professional development. In this particular case, it was only finance and CEO, but you see in real life, MNC is offering a variety of services, right from the IT services to the purchase, procurement services, purchase function. They have financing, marketing. So all of those is rendered by this. So the revenues argument is the TPO stated following information. Okay, this is what crucially the revenues argument is. What they are saying is, okay, if you have a cost plus 5%, normally these intra-group services, what they do is they just send an invoice with a markup. There is also a service agreement says that I will provide these services to you, and with a markup of cost, I will estimate the cost, not even estimate, it's an actual cost. They will figure out who are the employees who are working in the organization, what is the time spent for these subsidiaries in doing all these negotiations or doing this service, and they take that cost and then add the overheads and also make a 5% markup or 10% markup and then bill it back to the subsidiaries. Now, the question what the department is not challenging the markup. They are not saying whether that 5% or 10% is correct or wrong. They are challenging the basis of the cost arriving itself. How did you arrive at the cost? So the cost when it's arrived at, what is the benefit this company is doing it? Say for example, they went into an extent for one of the companies in the TP scrutiny where they mentioned, you have an information technology department in India. There is also an information technology available in US. So how is it different? Why should you take the help of US when you have your own employees? So is there a roles and responsibilities provided? So the cost whatever they are charging, is there a certificate which is being given by the other CPE? So they get into, so what they have called it is a need benefit test. Is there a need to provide that services by the holding company or any associated enterprise to India? Will it be purchased by the Indian entity from an outside service provider? So that is what they are trying to prove. So it's not the margin which is under dispute. It is basically the need benefit is what has to be proved. So in those kind of situations, what we need to advise to the client or what we have to ensure is they need to have a very detailed documentation. What's the kind of work they are doing? Why that work cannot be done by the Indian people who are there in India? And what's the kind of service they need? If this service is not done, they would have purchased it from an outside party. Will this be equal to that cost what they are talking about? So this is something which is happening in almost in most of the 90% of the cases. Even though you provide documentation, emails are not taken as proof for proving this. But you need to go beyond emails to demonstrate whether there was a real need to go for it and whether there is a benefit which has been derived to the Indian organization to prove this. So the revenues argument was no evidence services were actually rendered, because when services are rendered, what is the evidence you need to prove? So it has to be very detailed as possible. What is the kind of service we are talking about? No demonstration of the need or benefit. Personnel providing services are on AE's payroll, suggesting the work benefited the AE more than the assessee. And the cost allocation method was unidentified and lacked documentation. So this is what they mostly give. In spite of you giving a lot of documents, there is also a query saying that these documents are not sufficient. So it's always better to ensure that if there are intergroup services which is provided, we need to have the need benefit analysis before even the billing happens between the holding company and the subsidiary company. So the legal questions are whether the payment made for management services was allowable on the grounds of commercial expediency. This is the first point. We need to prove whether commercially or business wise does it make sense, whether disallowances can be made on other critical transfer pricing factors such as benefit test, duplication of services or inadequate documentation. So the revenue authorities cannot, so the High Court has said in favor of assessee, they have said the revenue authorities cannot dictate how a business should conduct its operations. This is very, very crucial. As a business, the business will always try to, the group will try to maximize its profits, minimize its cost. That is what is very, very important. So we need to ensure that whether the business is there or whether we are going to work for the TP provisions. So they need to also ensure whether the authorities or the revenue authorities understand the way the business is carried on, understand the need what is required in this kind of situations, because ultimately all MNCs, they have some shared service within the organization one way or other. That is inevitable for the simple reason that if you duplicate it for say 20 subsidiaries across the globe, all 20 of them do the same functions, you are going to duplicate the cost of manpower and personnel and the external service provider and also the cost. Economies of scale will work better if you consolidate all the requirements and then make it at one place. So there are companies which says that China will do all the purchasing function is centralized in China, Germany will do all the IT costs, there might also be a UAE entity will take care of marketing costs. So these costs will be billed by those respective entities, of course with an agreed thing, and they will have a proper tracking mechanism to prove that. So SE is not required to show that the expenditure has directly resulted in profit. So these are the things which High Court has said. They said the allocation, okay, this is very, very crucial. In some of the things like what I was talking about, a Microsoft license. If a Microsoft license is purchased centrally and allocated across the branches, they have the basis of allocation saying that based on the users they will allocate it. So there will be a back-to-back invoices of the third party and this. This is not provided by the group company itself. It is supported by a other outside, so that could be one of the argument to say that it is not, even though it's included as part of the invoice of the company, it is supported by a third party invoice and there is no profit element which is included for that. So this is again, this is also again the recent trend what the department comes in with on the AMP, the advertisement, marketing and promotion expenses. Department is challenging this. Here in this background, the Casio India was a subsidiary of Japan, and it incurred advertisement, marketing and promotion expenses to promote the brand and products in India. The resale price method was used to determine the arm's length principle, price of distribution of transactions. So they call something as a bright line test. That's a method which is distinguishing between a routine advertising, marketing and promotion from a non-routine one by comparing them to incurred by comparable independent persons. Okay, let's take hypothetically a company which is in India, which is not a part of a major group. It's not an MNC, it's not a major group, and it is only getting some minimal marketing expenses because it has to only promote it here. Because when you are talking about a brand, your brand has a value, and there the promotion and advertising expenses could be bigger than if you are doing only for a Indian based entity which is going to be in India, their marketing cost might be there. So the bright line test is talking about distinguishing this routine advertising marketing, because any company for that matter will incur some advertising marketing expenditure. But if it's going to be a part of a group, for promoting the brand, you might be incurring some major expenditure. So that is what they are trying to distinguish here. Substantial expenditure was incurred, and which has helped the creation of the brand, that Casio brand which belongs to AE. Should be separately benchmarked. Assessee should be separately compensated for the brand building efforts in India as a cost plus markup basis. So the question was whether the advertisement, marketing and promotion would qualify as an international transaction, and is it required to be benchmarked in the first place. So the decision was significant AMP expenditure does not amount to an international transaction. So this is also something, so this advertisement expenditure is with an outside party. It is not given to the AE. So what do you test in a transaction between the AE and the Indian entity is that which is transacted between the AE and Indian party, or there could be deemed international transactions where there is a global contract where AE is also a party and you are also a party, and the prices are tested by your AE globally. But here in this case, this company was paying this expenditure to an outside party. So you cannot just go and use some fancy words of a bright line test, legal validity in Indian transfer pricing, and you cannot reject it. That's the contention of this. And AMP expenses cannot be treated as a separate international transaction unless there is a specific, that's what we talked about. Because if it has to be a specific arrangement between the holding company says that they have also entered into a contract between the assessee and the AE for incurring such expenditure in India on its behalf. So say for example, the holding company has advised India, I want to do a global branding for my brand. So you incur this much of expenditure in India because maybe it's cheaper in India, and then that's what the cost you will incur. Then it makes some sense to say that it's a instruction given by this. But this entity wanted to promote the brand in India and it has incurred its expenditure. The resale price method is applied and the gross profit margins are within the arm's length price, no separate AMP required. See, the very purpose of doing a transfer pricing is to see whether a profit is shifted. So profit shifting happens, you have to prove whether there is a profit shifting. That you can prove it only by ensuring that if it's going to be a trading organization by your resale price method, or if it's going to be a service company by your transaction net margin method. So if you're having adequate profits and you're incurring the expenditure for it, maybe they're making more profits only because of this expenditure also. That could also be an argument by the assessee. So when they applied, the gross profit margins are within the arm's length and hence no AMP adjustment is required. That was a decision, that was a welcome decision, but the problem is in all these TP cases, there are more to all this. These are all new trends which the department is coming out. There's also some new additions which the department make than the usual things what they are coming out with. So we should be aware of these case laws. Any questions? Okay, thank you.
Thank you, ma'am. Actually, I didn't have the opportunity to attend the full session, but as far as the concern, I attended the session. It was so good, ma'am. Thank you. Thank you, members, for making this event success. Thanks.